Two guys. Same age. Same income. Same $40,000 saved up. One buys a rental property. One dumps everything into index funds. 20 years later, one of them is significantly wealthier. But it's probably not the one you think. I'm going to show you the exact math. No shortcuts. No cherry-picked numbers. Every cost included, even the ones most finance YouTubers conveniently forget to mention. By the end of this video, you'll know exactly which path makes more sense for your situation. Let's go. Meet Alex and Ben. Both are 30 years old. Both have $40,000 sitting in a savings account. Both earn roughly the same income and can set aside about $300 a month going forward. Alex decides to buy a rental property, a $220,000 house in a decent neighborhood. He puts the $40,000 down, takes out a mortgage at 7.2% interest, and starts looking for tenants. His plan? Build equity, collect rent, and let the property appreciate over time. Ben takes his $40,000 and puts it all into a total market index fund. He automates $300 a month in contributions and promises himself he won't touch it for 20 years. Same starting capital. Same timeline. Completely different strategies. Let's see what actually happens. Alex gets a tenant in month 2. He's charging $1,650 a month in rent. On paper, that looks incredible. His mortgage payment, principal plus interest, comes out to around $1,290 a month. So he's pocketing $360 a month in cash flow, right? Not even close. Here's what Alex forgot to account for. Property taxes, depending on the state, that's anywhere from $150 to $300 a month. Let's call it $200. Insurance. Landlord insurance runs higher than a standard homeowner policy, figure $120 a month. Vacancy. No property stays rented 100% of the time. The national average is roughly 1 month vacant per year. Spread across 12 months, that's about $137 a month you need to set aside. Maintenance. The standard rule is 1% of the property value per year for upkeep. On a $220,000 home, that's $2,200 a year, or about $183 a month. Add it all up. Alex's real monthly expenses aren't $1,290. They're closer to $1,930. He's not making $360 a month. He's losing $280. And that's before anything breaks. In year 2, the water heater dies. $1,100 out of pocket. In year 3, the tenant moves out, Alex needs to repaint and replace the flooring, another $2,800 gone. His cash-on-cash return for years 1 through 3? Roughly negative to flat. He's building equity slowly through mortgage paydown and mild appreciation, but in terms of actual money in his pocket, he's barely breaking even. This is the part that kills most new landlords. Everyone hears passive income from real estate and pictures a check showing up in the mail every month. What they don't picture is the 11 p.m. text from a tenant saying the heat isn't working. Or the eviction process that takes 4 months and costs $3,500 in legal fees. Or the roof that needs replacing in year 8, a $9,000 bill that shows up whether you're ready or not. Here are the big capital expenditure hits Alex can realistically expect over 20 years. Roof replacement, every 20 to 25 years, cost around $10,000. HVAC system, lifespan of 15 to 20 years, cost $5,000 to $8,000. Water heater, every 10 to 12 years, 2 replacements over 20 years, about $2,200 total. Appliances, plumbing, electrical, minor repairs averaging $500 to $1,000 a year. That's $20,000 to $25,000 in guaranteed future expenses. Spread out, but absolutely coming. If Alex decides to hire a property manager, which most people eventually do because the passive part of passive income is a myth, that costs 8 to 10% of monthly rent. On $1,650 a month, that's $132 to $165 going straight to the management company every single month. After all real expenses, vacancy, maintenance, capital expenditure reserves, taxes, insurance, the honest cash-on-cash return for a typical rental property is somewhere between 3% and 6% annually. Not the 18% someone told you about at a dinner party. Meanwhile, Ben hasn't done a single thing. He set up automatic contributions and went back to living his life. His $40,000 initial investment plus $300 a month at a 9% average annual return puts him at around $97,000 by year 5. He hasn't fixed anything. He hasn't dealt with a single tenant. He hasn't lost sleep over a vacancy. His money is fully liquid. If he needs it, he can sell in minutes. His downside risk? Yes, markets drop. In 2008 the S&P fell around 38%. In early 2020 it dropped over 30% in weeks. But every single time, it recovered, and went higher. The key is Ben doesn't sell. He keeps contributing. He lets compounding do the heavy lifting. By year 10, the picture gets interesting. Alex's property has appreciated at about 3.5% per year. His $220,000 house is now worth roughly $312,000. He's paid down about $24,000 in principal. His equity sits at around $116,000. His cumulative cash flow after all expenses is roughly break-even. Total net worth from this investment, approximately $116,000 to $125,000. Ben's situation, $40,000 plus $300 a month at 9% annual return over 10 years comes out to approximately $115,000 to $120,000. They're almost exactly even. But here's the critical difference nobody talks about. Alex spent hundreds of hours managing his property over those 10 years. Ben spent zero. Alex has one illiquid asset tied to one local market. Ben is diversified across thousands of companies globally. And Alex still has over $110,000 in mortgage debt. Ben has no debt at all. Same wealth. Completely different risk profiles. Now let's go to year 20. Alex's property at 3.5% annual appreciation is worth approximately $442,000. His remaining mortgage balance is around $95,000. Net equity, about $347,000. Add cumulative positive cash flow from the later years when rent has risen and the mortgage stayed fixed, another $30,000 to $50,000. Total wealth from the investment, roughly $370,000 to $400,000. But to access that $347,000, Alex has to sell the house. And when he does, he'll pay closing costs, agent commissions, and capital gains taxes. That can easily eat $30,000 to $50,000. Net after-sale wealth, closer to $320,000 to $360,000. Ben at year 20, $40,000 plus $300 a month at 9% for 20 years comes to approximately $430,000 to $460,000. Fully liquid. No selling process. No agent. No closing costs. Ben wins on total dollars, and did it with 0 hours of active work. Now here's where I have to be honest, because those numbers are for an average rental property. Real estate can absolutely beat the stock market, but only under specific conditions. First, a strong rent-to-price ratio. If Alex had bought in a market where he could charge $1,800 a month on a $180,000 property, his cash flow numbers look completely different. He's profitable from day one. Second, house hacking. You buy a small multi-unit property, live in one unit, rent the others. Your tenants cover your mortgage. Your housing cost drops to near zero. Over 5 years, the compounding effect of essentially free housing is enormous. Third, leverage in an appreciating market. Alex put $40,000 down to control a $220,000 asset. If that asset goes up 20%, he doesn't make 20% on his $40,000, he makes 20% on $220,000. That's $44,000 in gains on a $40,000 investment. A 110% return. No index fund gives you that kind of leverage. Fourth, tax advantages. Real estate investors can depreciate the property on their taxes, essentially deducting a portion of the building's value every year as a paper loss even while the property actually appreciates. Add 1031 exchanges, the ability to roll gains from one property into another without paying capital gains tax, and sophisticated real estate investors can compound wealth for decades completely tax-deferred. Stocks win in more situations than real estate, but only if you actually invest and leave it alone. The biggest advantage is contribution flexibility. If Ben increases his monthly contribution by just $250, from $300 to $550 a month, his 20-year total jumps from $460,000 to over $600,000. Stocks also win when you don't have the time or temperament to manage a property. When you want full liquidity. When you're in a high-cost market where rentals don't cash flow. When you value diversification. And when you're early in your career and can ride out volatility. The one thing most people get wrong about index investing. They sell during downturns. The market drops 30%, they panic, they sell, they lock in losses, they miss the recovery. Ben's strategy only works if Ben stays in his seat when things get scary. That's harder than it sounds. Here's what nobody in this debate wants to admit. The real enemy isn't the wrong investment. The real enemy is inaction dressed up as research. Most people spend years debating real estate versus stocks, listening to podcasts, watching YouTube videos, and never actually do either one. They keep the $40,000 sitting in a savings account earning 4.5% while inflation quietly eats it alive. Both paths work. Both have made ordinary people wealthy. The math proves it. The question isn't which one is better in theory. The question is, which one will you actually execute, maintain, and stick with for 20 years? A decent real estate deal you actually close beats a perfect one you never pulled the trigger on. An index fund you contribute to consistently beats a sophisticated strategy you abandon after the first market correction. So, real estate or stocks? If you want simplicity, liquidity, and solid long-term returns with zero active management, stocks win. If you're willing to treat it like a real business, find the right market, use leverage strategically, and optimize for tax advantages, real estate can win big. If you're starting out and don't have the capital or experience for investment property yet, start with index funds today. Build your knowledge and capital at the same time. Don't wait for perfect. And if you can do both, do both. The wealthiest investors aren't usually choosing between real estate and stocks. They're using both, and letting each one do what it does best. That's the real math. No hype. No shortcuts. Just the numbers. If this video helped you think more clearly about where your money should go, hit that like button and subscribe. Every week I break down personal finance and investing topics the same way, with actual math, actual costs, and zero fluff. Drop your questions in the comments. I read every single one. See you next week, share.